All right, well, this is going to be recorded. So anybody who comes in late can obviously catch up. I don't want to waste any time for people who are here on time. And so I want to thank everybody for joining us. Let me make some really quick introductions, and then I'm going to turn this over to you guys. For those of you who don't know me, my name is Corey Wright. I'm a business coach. I work with leadership teams of growing businesses to help them grow faster and hopefully do that with less stress. I do that through a number of kind of meetings with leadership teams, and love what I do and have the opportunity to work with a ton of great teams all the time. I also have the opportunity to work with Allan, who is my CPA. As an entrepreneur over the last 20 years, I've worked with, I think, 4 or 5 different CPAs. And I can hands down say that not only is it a difficult task to find a CPA that you really work well with and trust and enjoy, but also enjoy as a person. I've got to spend a lot of time with Allan over the last 3 years that we've been working together. And I truly enjoy you and your team. And I just want to thank you for what you guys have done. You've taken a relationship that often is one of those kind of afterthoughts and things that you really don't want to think about with your CPA. I really enjoy every time we have the opportunity to talk and chat and all that stuff. And so I'll introduce Allan, if you want to give a quick wave. He is my CPA. Dianne is the Director of Operations at Allan E, Hetzel Associates. I'm going to give a quick wave, Dianne. And then Bill is the Tax Director over there. He's also a CPA. All 3 of them are going to be contributing today. The goal here is I work with a lot of businesses that that kind of fill the finance seat last. And what I've found is that the businesses that really pay a lot more attention to the finance seat and put rather than it kind of being an annoyance or an afterthought, they actually make it something that's driving revenues and bottom line in their business, gives them a lot more insight, have this kind of revelation, this switch flips. And so I wanted to invite Allan in to just kind of share. I know this is something that you and your team do with businesses regularly. And so that's all I'm going to do. I'm going to stop talking. I'm going to turn it over to you guys. They've got a presentation that will last 30 to 40 minutes, and then we'll take some Q&A. I'm calling it Ask My CPA Anything, which I think is great. So it does not have to be on the content we're covering today. Anything you've wanted to ask a CPA, you can do. And then I want to point out that afterwards, they offer a free 15-minute consultation to anybody. And again, it doesn't mean that you're trying to hire them, or if you just want to ask a CPA anything for 15 minutes, they have one of the coolest Calendlies that I've ever seen. It's called Talk Taxi to Me. First time that came through, I lost it. I thought that was hilarious. I still see that every time we get to set that. So Talk Taxi to Me. If you guys want to book that, I'll have links in the show notes. If you guys are watching this afterwards, you can also view it at calendly.com/1040tax. That'll be a way that you can schedule 15 minutes with Allan. I want to thank everybody for being here, and then I will turn it over to you guys. Feel free to type your questions in the Q&A. We'll get to those at the end.
Excellent. Thank you, Corey. Thank you, guys, and thank you for joining us today. I want to go ahead and start off and welcoming. And one thing that I've noticed throughout the years, more than anything, in America, and this is a quote that I love and referencing over the last 12 years, in America, there are 2 tax systems, one for the informed and one for the uninformed. Both systems are legal. As we move into this webinar, what I want to make sure that you guys, what we're going to expect, the 4 financial basics every business should understand: how to clean up the books, proper record keeping, the biggest advantages for the companies, especially with Biden's laws coming in for the businesses, and some of those new laws that are proposed to be changed, how to clean up your books, financial reporting, and then why a contract CFO could be that missing link for some of those businesses that are expanding. So this is presented by Allan E, Hetzel Associates, and this is a portion of the team. I've got myself, Bill, and Dianne, which I'm really excited. And then for us, it's not just me. We've got a team of people. We focus on privately owned companies from 2 to actually 5 to 250 employees, and we can do it nationwide, real estate professionals. So we have a lot of expertise. We can issue reviews and compilations. Trust, you name it, we can focus on a lot of those things. So we are a full service firm. So we have the expertise in being able to help you. And we're sharing some of the experience that we've seen over the years in helping our clients. And one of the things that I enjoy doing most, and I know the team does too, is in business, what we have found, and even with new clients, it doesn't matter the size. If they're 200,000, 20 million and 200 million, we realize that the business oftentimes they aren't aware of their entity structure and some of the benefits because of, and especially if there's rapid growth. So one of the things that I start off, it does not matter, is I kind of do like a slingshot method. I'll educate the business owner of what's going on, we'll analyze of what's happening, and then we'll implement and then improve. Many of the businesses that we work with will go from 2 to 3, 8 to 10, 10 to 25, 25 to 50, and they have, and it's a lot of fun, they have almost the same issues, but at each stage it changes, where we kind of repeat that process and then analyze that and take great opportunities to improve their business. So the thing that I come across, and it doesn't matter, because oftentimes I see this a lot of times with the controller or even with the CFO, they may have been hired when the company was at 10 million. But now the company, when I get involved, there was a mistake. Typically, it could have been anywhere from $1 million to 2 million. They went from 20, they dropped. So then what we'll see is in the business, I go straight from the basics. And the funniest thing is the business owner and even the controller, and sometimes that CFO may be like, this is the first time I've seen the tax return. Or, hey, I didn't know that we were, on cash basis. So, or hey, we're a 630, or one of the clients brand new, we're on a 1031 year and close. So I confirm that. And that's important because that tax return, that balance sheet has to match the financials as we move forward. So those retained earnings, and it's a best practice that I do, because 9 times out of 10, if it's a brand new client, I see that missing because someone made adjustments or a timing issue behind that. And then I go right into the basics in reviewing the customer accounts, see what needs to be done, clear out some of the outstanding deposits. And this is kind of the high level that I'll do within the approach. And one of the reasons why is a lot of times in the compensation for the officers, they're not maximizing that QBI deduction. So they're essentially paying more in taxes than they should be, or they don't have the executive compensation plan that they're tailoring. But in that process, what I find is that there's mistakes or old credit cards that could be consolidated into one account. So at the end of those things, what I find is once we get that high level and help them understand those things, and for a lot of you guys, you can email me or Dianne and the team. I'll give you a monthly account checklist that I go through with the team, and Bill does too. And for Dianne, it's very process. If you didn't check it off, it didn't happen, because I've seen even the best CPAs, what happens is as they scale, they were hired at 5 million. The company is now 10 to 15. Their team, they assume the senior accountants or some of those controllers, the assistant controller knows how to do these things, but that unspoken thing of the communication, no one's doing it. And they find out, hey, we need to write off some of the things, or hey, why are there write-offs in accounts receivable? So I can send this over to you. It's really nice and sweet. You can tailor it to how you want. Email me at allan@hetzelcpa.com, and I'll make sure to get that to you, and you can adapt it to the process that fits best for you. After you finish and kind of doing those reports, what I recommend, and this is really cool and what I like to do, have a comparison. Even the best, and I joke about it all the time, CPA, compare, prepare, and analyze. Even if you're the best and you're not comparing, you're gonna miss some things. We see that in the balance sheet, profit and loss with the reports, especially if you get new staff, they end up adding different expense accounts that are similar, but can throw off the GL. So it's and even the biggest companies, I see that, especially in rapid growth or change, or in the event, a lot of times when someone passes, we get brought in as that contract CFO. So I see those mistakes right off the bat, and I just go, hey, why did this change? And you can see it, and it's an obvious. And yes, I recommend going from the beginning of the year to 12/31 with a comparison, because you'll kind of see some of those things before the end of the year. Oh yeah, we've got insurance. Oh yeah, we've got these expenses. So then we can either negotiate those expenses before they come up. And then the most important, where I know, Dianne, we talk about it all the time, in your business, you really have about maybe 8 months that you can really sell. And the rest of the stuff is maybe operational improvement. And I know Dianne and I, we were talking about that today, and you can give some insight on it earlier, Dianne, of why it's so important to look at this at kind of a 12-month back in the comparison. Dianne?
Yes, the reason why we look at this is if you think about it, it's actually the pulse of your business or the heart of your business. If you look at this sheet that is actually on this report, you can see where the revenues are low, May 31st, where they must have probably started their business. And there's, for some reason, on August 20, revenues went down more than half. So what you usually do as the owner of a company is you need to be able to make sure that you plan for this on the next coming year, coming 2021. Okay, what would be my plan when we come August? Was it because everyone is in summer, nobody was in the office, whether we have too much employees that were, in the office at that time and we didn't have enough sales? Should we plan sales 3 months before August so that we make sure that we invoice all of those stuff by August, coming August? So as a business owner, you want to make sure that you are on the pulse of the business every time, and you at least make an analysis of it 2 times in a month. And the reason is you need to know how to make sure you manage your team, and at the same time, you also make sure that you manage your cash flow. Allan?
I love it. And she's absolutely right, because in the business cycle, if you know that most of the business is going to close in January, and with the holidays, November and December, that there's going to be some stagnation, take some holidays, do some improvements. Maybe that might be a good time for some implementation, but you can plan for some of those bad months and really capitalize on that. Kind of like what we do, that July and November are a little bit slower and different. So then we implement new strategies, software, and it's a great time for us. And that's why moving forward, I want to kick off to Bill and why that's so important, having good reports. Bill?
Thanks, Allan. So, it's really important to have accurate records, and it's really something that not everybody pays attention to or has the time to really look at it in depth. So, and when you're moving forward, what you want to do is you want to make sure that you're doing some reconciliations on a regular basis and setting aside a certain time each week or each month to go through and do your bank reconciliations, your credit card reconciliations. That's really a key thing to make sure that all your expenses are being accounted for and that you don't miss anything that possibly you could be taken as a deduction on your tax return. And then look at setting up auto payments as much as you can. A lot of vendors will do that for you. A lot of credit cards, a lot of other your expenses can be set up so that they're paid automatically, which takes another task off of your table each week or each month. And the same thing with looking at your vendors and seeing if you could pay in advance, do some upfront pricing, get some annual discounts. A lot of them will do that for you and avail yourself to these open discounts. And then look at some of your expenses. See what expenses are bringing value to the business. If you're going to go out and you need to buy a new car, does it make sense to go out and buy a Range Rover, or can you get the same job done with a less expensive vehicle? And look at what assets are generating money for you. Sometimes you want to buy new equipment. If you're in the Stone Age, have some old equipment there. Well, if you step up to the latest technology, maybe you could be spending less time doing whatever you're doing now, and it's going to generate more income for you. And then also look at what your average hourly rate of the company is. And that's looking at your revenues divided by the hours that each person is spending in there. The average hourly rate is what a lot of people are looking at to see what their staff is bringing into the company and what kind of revenue each person is generating on an annual basis. And the better your numbers, the better planning, the less missed deductions you're going to have. Some things that you want to look at, some things that are available out there are research and development tax credits, where you're able to get additional credits because you're improving the process of whatever procedures you're doing. Cost segregation studies, you're generating additional write-offs by accelerating depreciation on properties. That's something that's really good out there, that you can get a lot of additional deductions in the short term. Then there's also executive compensation plans, setting up some different compensation bonus arrangements. You have bonus depreciation. At least where the current tax laws are right now, you can get a 100% write-off on a lot of the equipment if you're looking at buying some way down the road. But for right now, that's something to really look at. You have non-cash deductions. If you're donating some things, getting those things off your book, maybe the equipment's already fully depreciated. You can also look at maximizing the QBI deduction, which is a qualified business income deduction. And there's certain ways to do that so you can actually get that additional 20% deduction as it flows through to your personal tax return. And one of the good things, one of the best things to do is to keep good records. If you ever get an audit, you know, no one likes to get an audit, but it does happen sometimes. The best thing is to have good records. We have a retention guide right here. Normally want to keep your business records for, you know, at least over 3 years, 4 years for the state. Same thing with your personal records. But it's always good to maintain not only the hard copy, but keep your digital copies in there, have your systems up to date. And we have a retention guide that's available for you. The slide right here has it on the bottom at hetzelcpa.com/retention guide. Allan.
I love it, Bill. Thank you so much. And then as we move forward, which is really important, is a lot of times, especially right now, with the current tax laws coming into place with the corporations, what's happening, and a lot of people are worried of what's going to be happening, especially as taxes are increasing. And the question, you know, I get a lot of times, when do I need to incorporate? Or this client, a brand new one, I got a construction company, very good at what they're doing, 21 million in sales, and then now they've got over 250 vehicles, and they are not set up with the right structure, and the liability is being come up to where they do not have the right entity structure. So one of the things that I look at, and it is common, hey, do I need to incorporate? Do I need to have the right entity structure? Do I need to have the LLC with those vehicles and have that corporation lease those vehicles back? And then a lot of times what, you know, I ask, hey, why did you incorporate? And they're like, oh, well, so-and-so did this. And typically they aren't the best entity structure. So we look at, okay, hey, for some of there's timing components, especially if you're a sole proprietor and your net revenues are going to be, net profit is around that 55,000 and above. You want to incorporate, especially given the tax law is written very pro-business. It makes sense. What I recommend that you do, though, is that you work with your tax advisor, your CPA, and your strategic advisors before incorporating, because setting up the right entity is really important, especially as you're growing. Or what's the whole purpose? If you're a startup and you're looking to sell to get a private equity, you know, setting up a partnership is not the best idea, or that LLC. So it may be strategic to set up that C-Corp, set up the shares, and set up that proper value for those shares, so you can have acquisition within the cap tables, and we can have the team to help you out that, because with those startups, your beginning setup is so important. I'm going to go pretty quick in this for the different entities, as we'll have the recording, and that you guys can reference for future. So, and Corey will have these up for the S-Corp. Super easy to do, really easy, not difficult. The partnerships, super important thing, the operating agreement. The operating agreement, the operating agreement, the operating agreement. Like, operating agreement. You need to basically, as you're getting up, you need to set up that divorce paperwork as you close basically the LLC. You need to look at how you're going to wrap this up, because that operating agreement is so important for the LLC. So that's really tough for a lot of people. Hey, we're getting in business. Now, how are we going to wind this down in 5 or 10 years? So in the exit strategy within the partnership, super important. And the same thing with the LLC. If you're going to have multi-members, make sure you write that operating agreement. You have an attorney look at it, because there are some components. And then, especially for real estate, kind of a tidbit, you do not want to have a California LLC owning rentals outside of California. So very specific. Make sure that you're working with an attorney, your CPA, on setting those LLCs strategically, like we're doing for a lot of our clients. They may have property in Texas, so we have that set up state specific, and then they have the income here, you know, their normal business here in California. We can set up strategically and making sure those two are separate. Typically, the state specific is the better option, but make sure you work with your tax advisor, CPA, and attorney on this. The corporations in a nutshell, especially if you're looking to acquire the C-Corp, it can be the best option sometimes based off of what you're looking to do. If you're a service-based, the C-Corp might not be the best option unless you're a doctor. You can have that closed corporation in there, and that's important. And then as the income goes up for the thresholds of what they're going to be taxing at, there's a strategy behind that in creating that family back office with those C-Corps. Contact us. We can help you out, especially if your income is going to be over that $400,000 taxable. The C-Corps can become an option in kind of controlling your income in correlation with your other businesses. So a strategic kind of advanced tax planning behind that. S-Corps are great for most small businesses or service-based businesses because right now, under the current tax laws, the S-Corp and you are viewed as two separate people. So it's a great component. Make sure it's set up properly because you get the benefits of being the business owner, the shareholder, and the officer of the business. So really important that it's set up correctly. As you go into the businesses, one of the things that you really want to kind of watch out for is the ownership and profit allocation. Making sure the reasonable compensation is done correctly. And then if you have a considerable amount of taxes as a business, look at the entity structure because that can often be a cause of the taxes. So make sure to seek advice on that. The big thing, especially for businesses, which you would want to look at, and we kind of touched it a little bit earlier, is that the QBI deduction and that S-Corp with watching out on the salary and taking reasonable compensation. So this is really important because you could end up overpaying yourself, buying a vehicle, taking the Section 179 depreciation or the accelerated, and you lost that QBI deduction. And we see that a lot. And you basically overpaid in taxes or overcompensated yourself, or they're missing some deductions. And again, the executives are not getting some of the benefits out of the corporation. So really important, if you're looking to lower that self-employment tax, the corporation can be a strategic tool in doing that. And we see that as a great option. I give a kind of a brief overview of the different companies, especially for a lot of our startups that are the software, the telecommunications, and they're looking to get those private equity. The C-Corp can be a great option. The S-Corp, good for the small. LLC, really good for assets or for the real estate, or when you're kind of just starting to protect your liability. The general partnerships can be good for land development, and of course, those sole props are very easy to set up. But as we move into the proposed tax laws, having that right entity is so important. So I joke about it. No one knows what the laws, is going to be today and what it'll be tomorrow. So why that's so important is that, everyone always asks, hey, should I use an attorney to set it up? Do I need a lawyer? And a lot of times, depending, hey, what are you trying to do? What's the goal? Should you use one? And I joke about it. Yes, but parental guidance is highly recommended. So, have that CPA, have your tax advisor helping out so you're not playing that what if game. And the reason why is if the attorney knows for this reason, boom. That's going to save you a lot on the fees, but make sure that you have the right legal and tax structure. So very important. Could you build the house on your own? But should you? Typically, what we see in the LegalZoom, or if they're setting up on their own, the operating agreement is incorrect with the income allocation. They're up correctly. That's putting a lot of money in, and you get one partner that's got a lot of sweat equity. Well, if you set that up incorrectly, that partner that put all that money in might not get his money back as quickly as he wanted to. You can tailor that operating agreement. Hey, I get the losses first. Once we get profit, we can do maybe a 60-40 split. So that operating agreement with the LLC is often set up incorrectly. For corporations, they didn't issue stock. If you don't have stock, you don't have a corporation. So
Yeah. This year we had someone who gave us a tax return, and it was their first year for doing their tax returns. They didn't issue stock.
Right, and it's a good sized company too, where they were expanding. So it often we see issues with this for clients, and then the Secretary of State, and making sure the corporate minutes are done. They didn't do it, and then also the S election. So really, really, really important making sure that's done because they actually might have issued preferred stock with S election where you can't have two classes of stock with an S-Corp. So that's really important to make sure you're doing it correctly. So oftentimes we recommend a lawyer, especially if you're having other people involved and you're looking to grow the business. So one of the common mistakes that we see with a lot of businesses, especially starting up, is they're not compliant, they're not maximizing the deductions, they're not setting the goals. Again, the technology, they're doing it all alone, and typically they're hiring the wrong people, and we see that there's a failure to delegate. So it is important before you hire anybody or bring anybody on the team, work with Corey, work with us, work with your team, because you can do a lot of things before making some of those top mistakes that we see. And one of the top mistakes, which I'm going to introduce Dianne to talk more about, since she heads up our HR, is talking about the payroll requirements. Dianne?
Okay, I know a lot of you guys sometimes would pay people under the table. Well, California is now honing down on those a lot of things. So we want to make sure that we're compliant at all times in regards to payroll requirements. Even if someone you hire for a certain project, you guys only paid them $300. Even if it's just $300, it's still very important to make sure that one, you record it on your books. Two, you make sure that they sign a W-9 form to make sure that it's recorded and it's submitted to their either EIN or social security number. Make sure you do not engage any of your independent contractors without them filling this up. Allan, can you go to the next page? The reason is there are a lot of changes in the laws and the regulations that come up with the California law right now. We all need to stay compliant on all of this. It is very, very important because now those are red flags for audits. And who here wants to get audits? I wouldn't. Your corporation wouldn't want that. You would pay big penalties if you have an independent contractor and they are not in your books. You don't have any of their social security, or worst comes to worst, you could even get sued by that independent contractor yourself. So this W-9, please don't take it for granted because it's very important that you guys have that, especially when you're hiring someone. At the same time, you also need to know the true cost of your project or your job. You could hire a contractor and maybe hire him again over and over again, but how do you know if you're profitable if you're not recording that as a cost? Also, one more time is if you're hiring a contractor more than once a year, or maybe every month you seem to be paying this person at least 2 weeks of wages, is it time to turn him into a part-time position? You might want to think about that because maybe you'd be more profitable if you hired an independent contractor as a part-time position. So you really need to make sure that one, there are several ways that you can do this. Is you can hire a service and which is a lot cheaper than you doing all the payroll for your business. Two, you can stay compliant because a lot of the payroll services now that we have, like ADP, Paychecks, do you know anything else? Benefit ones.
Smaller ones that can tailor within technology, give the company. And then one of the things that we joked about it, anybody who's not blood related, like make sure to get HR, especially with a lot of changes this year. Dianne?
Yes, and the thing is, remember when COVID hit, when all the laws changes, and make sure that when you have people in, they have all of these protective devices. Also, now you have to prop up all of this plexiglass and all of that. And I'm sure not everyone was on time when they implemented all of this. However, if you do have a payroll company that you work with, they already all have all of these HR documents that are needed for to follow during the COVID times. They also have all of this updated HR rules and regulations that everyone needs to be in compliance on. And you don't have to put extra effort on it and doing the research or even have your HR do all the research for it. It's all packaged for you all at once. And to pay for this is actually like 1% of what you actually pay for an HR expert. And as you know, all of us, we're not all HR experts unless you guys would have someone who has an SHRM title who makes sure that she is up to date with every single thing on HR relations here in California and federal. It's like also hiring a CPA. You would want to outsource that too and have a payroll service to take care of that. Allan?
I completely agree. They're constantly changing. Do not be out of compliance. We see that oftentimes, so we catch that up for a lot of the new businesses because we see the violations, and you don't want OSHA or as we see the independent contractors, especially with unemployment, those independent contractors reclassifying themselves as employees, even though you did everything right. That person would be like, well, I only worked for this person. So, and they'll try to get those unemployment benefits in there. So make sure, get a service, hire an expert. Thank you, Dianne.
Yeah, and then one more thing before I forget, and I think a lot of the businesses would know this, is when you guys applied for the PPP loan, who had all of their payroll information ready?
Right. Yes.
Yeah, precisely. So if you had a payroll service that's controlling that, they had that report ready in one push of a button.
I like it, Dan. Perfect. Saving time, saving money, and definitely being protecting the business. And the reason why that's important too is in the tax code, if you're being proactive, you can leverage a lot of the benefits behind the tax code. And one of the things that we see often, it's a huge audit audit item. There's the home office and the business use of the home, and how to lower that. So a lot of people, if you are not the correct entity, you're going to get in trouble for the home office, and especially for this year. Was it mutually exclusive for business? If you can tell me that the kids never ran in to that office, or there's no personal use after hours, you really can hurt yourself for that home office use, especially if you're an officer of the business, or if you're a sole proprietorship or LLC. So really important on that structure. Why do 90% of businesses fail, and you could too? What we see is a lot of times as business owners, they're kind of running circles within the same situation, and that same thinking on how they created the problem, they're looking to solve it. So that's where Corey comes in as a great asset, and even for us, we see that it's a different perspective, and really a lot of the same problems are what most business owners are going through. So we were able to take that, since we've helped so many other companies, and we can take you on that same path. So in the business, one of the top things that we see, of course, is poor accounting. Basically, and I kind of look at it as you're using a hammer and nails, and there's no kind of like exit strategy. And what we kind of look at is you want to kind of run the business like you're going to sell it. And the reason why is because you're going to end up being a little bit more efficient in what you do. And what we see is a lot of times, because of the poor accounting, they're overpaying in taxes. And because they've got weak accounting, they're not able to get the capital that they need, which then affects the location that they need for the equipment. And there's a lack of planning. Of course, that succession plan is so important, especially transitioning the business. And because why that's so important, and this part I love the most, and a lot of the stuff that we do is a lot of them are like, it's not like, I'm not moving the needle, like it's not making sense. And a lot of the times that I see, especially for this client that we had for, the monthly income coming in, they're looking at, okay, hey, we're generating income. What, like, we just need more leads. We need more business. I think help. And that's what really is going to help us out. We just need more business. Well, what we find, and we do this growth equation, and basically almost like a reverse burn rate for a lot of the startups, is that for most businesses that have been in operation, new business, which they think is going to help them, ends up actually hurting them. And what they need to look at is first, hey, the client acquisition cost for new clients is extremely expensive. What can we do to upsell, cross-sell, And typically, most clients need to improve their internal operations first before taking on any new revenue. So, and that's a big thing that ends up hurting a lot of the businesses. They'll invest in this marketing campaign, they're getting new leads, but they're getting cash coming in, and they're like, it's just not working. And a lot of times we see that early on, that they can't take on that new work because the cost of acquisition behind those. And a lot of times in certain areas that we kind of see, especially if it's software or implementation or outsourcing certain components, if we increase that, that can also help with some of the capacity for some of our current clients. And we see that all the time, especially for new engagements. We'll get them operational, and then we'll get that new team in place, which ends up helping them out. And then one of the things for a lot of us, getting specific, there are about 5 ideal clients that you really like or style, and reserve those first class seats. So that's important, because then it can help you focus on, hey, what is it that who are we really trying to focus, and what's that target? So then when we get those new clients, hey, here's who we like to work with. And then you can kind of create a client classification within your business. How much is each client bringing revenue to the firm? And it's a great strategy, because then you can kind of look at, hey, here's the clients that we need to cut because they only bring in less than 0.5%, but they're causing 20% of our problems. So very important to do each year within the business. And as that contract CFO, just like your iPhone, use it as a tool. And how we use that is really important, because choosing the right candidate for your business, you want to make sure a lot of times, hey, are they industry specific? There's a lot of candidates within the CFOs that you can be very strategic with, and you can either have a salaried, CFO that oftentimes is becoming stagnant, mainly because the business has grown. They don't have the team, which why we're generating a lot of business from is that contract controller, or they're losing some key senior accountants in there. So they're helping the business maintain, but they don't have the tools and resources to help improve or eliminate or delegate. And we come in that a lot of times for a 6 to 9 month engagement and help that business optimize in what they're doing. So I recommend with those, a lot of times what we see is within the employees, sometimes, they need some push. And then what we see is there's some software components that they can implement to a new CRM. Hey, we need to then optimize in what we're doing. How can we measure, our average hourly rate? And getting some outside knowledge is key in doing that. For those cost-effective methods, especially for the contract CFO, they're not salaried. The benefits, it definitely can be helpful, because what that can do is within the business, that can keep overhead down, and you have that interim component, which a lot of times business owner might pass. They hire us for a 6 to 9 month engagement, and we'll hire that new CFO that comes in. So hiring the right CFO and those cost-effective employees is really important, because then that's going to let the right tech coming in. For a lot of the businesses that's scaling, especially now, QuickBooks Online is a great tool for the beginning, but what we want to see is, especially for some of those cloud-based applications, hey, does that employee have that option to work remote? And a lot of employees want that, to have the ability to work remote. And that's going to be really important, because within that technology, are they communicating with other systems that you have within moving into the next level? Does it make sense to get a new server, or should we have it cloud hosted? And really important, we help our clients determine that, because it's extremely important. Because why that is because your CPA is completing and reviewing your tax return. Your internal team is completing your business and the basic process. Your bookkeeper, they're helping reconcile and avoiding, they're touching the stuff that's hitting the bank account. Your tax advisor is helping reduce the tax liability. And what we see is the team is not actively communicating together. And especially on the gross revenues, we see that a lot of times for those clients between, I should say, 1 and 50 million. There's not that connection a lot of times that we see that where they're all on the same page, which creates some great opportunities. So with these services, make sure you're engaged. Make an appointment with your current CPA. Hey, am I engaged for tax planning? And a lot of times they find that they're not. So there's those unexpected basically expectations that they're assuming that, hey, he or she's going to notify me in this, but oftentimes they're not. So if you don't hire a contract CFO, that's okay. Your competition is. And we see this a lot given especially last year with COVID, a lot of the CPAs and those firms have become a strategic advisor. And that's why even Corey has done very well because there's that advisory component that is necessary. And a good CFO, especially within their implementation and what they're doing, and what we see is whatever's implemented, that the cash flow behind it ends up saving them, especially over that 3-year time period. We have tools where we can even measure that on the implementation, like, hey, it's costing you $50,000, $60,000 a year and not, implementing these tools, or a lot of times they're not leveraging that QBI deduction. So we can kind of see, hey, if we stay on the same path, it's going to cost you, maybe $1 million in extra tax over the next 3 years. Yes, that extreme, given that the business is growing. So make sure, contact us. We can help you. We work with CPA firms across the world, so we can leverage and help any that you might need in industry specific. So one of the things that I always recommend for us, definitely be proactive. We can help you out. We've got the Calendly, we've got the scheduling time, and especially for those that are interested, we can help you out, answer those key questions that you guys need, which is really important. And I want to say thank you guys so much. And Corey, I leave it to Q&A.
Cool. Well, thank you guys very much. I think I learned more in 45 minutes than I have in about the last 6 years when it comes to taxes and finances for the business and all the structure. I really want to thank you guys. So we had a couple questions come in. A couple people wanted to know a little bit more about the QBI deduction. I think kind of what that is and how it can benefit them. Do one of you guys want to take that on?
Yeah, I will. The QBI is the qualified business income deduction. And what that is a 20% additional tax deduction for flow through income. So it's coming from either an S corporation, a partnership, or an LLC, or a self-employed individual. So whatever the net income is, you get an additional 20% of that as a deduction on your individual income tax return. So those flow through entities also have some other requirements, like an S corporation has a salary requirement that you have to do. So you really want to manage that and not take too much salary. I think Allan was pointing out that you could take too much salary and then take some accelerated depreciation and zero out the entity, and all of a sudden you have no pass-through income to come through, which is a good thing, but you're maybe spending too much in salary where you could have used that QBI to get a tax deduction on your personal tax return. So that's looking at that and analyzing it and determining how much salary you want to take, how much you want to spend is going to help you generate the largest QBI or qualified business income deduction.
Cool. Had a question. I'm not sure if you guys will have the exact answer for this off the top of your head, but somebody asked, as a realtor, we've got a couple realtors in the room, hey, everybody, having a license, can we have an LLC? Can a realtor in California have an LLC?
You want to do that one, Allan, or what, me?
You can fire away.
Yeah, so I believe in California you can have an LLC, but I don't know that you really would want to do that. And the reason is, so the commissions that you generate are probably going to be reported to you under your personal tax ID number, your social security number. So that's not the big issue. You can have that as a nominee income on your personal tax return and then bring it over to your LLC if you wanted to. But then when it comes through, you're going to be paying self-employment tax on that entire amount of income. So I probably wouldn't look at an LLC. I would probably look at more of an S corporation to have that income flow through to the S corporation. You take your salary, and then whatever income is remaining, not only do you get the 20% QBI deduction, you don't pay self-employment tax on the rest of that income. So you're saving yourself at least 15.3% on that additional income that's passing through to your personal tax return. So Department of Real Estate wise, I don't know if you could have commissions paid to an LLC or an S corporation, but there's a workaround around that no matter what.
And I believe the answer is you can have your commissions paid directly to an S-Corp or an LLC.
Yeah.
Another question, we have an S-Corp. Where on my current tax return would you see QBI deduction? I want to make sure I'm taking advantage of this. Do you guys know exactly where it would be? It's about halfway through, I know that.
It's on page 1 of the tax reduction. Let me see. It's on line 10 of page 1.
Line 10 of page 1, cool. And then it gets itemized somewhere back in the tax return. I remember.
Yeah, as a form 8995 in the back of the return, that'll flow through from.
Bingo. All right. How random are IRS audits, and what should we do to minimize our risk of being audited?
Entity structure, entity structure, entity structure. So if you're a celebrity, high net, so if you're making over $1 million a year, and then typically what we see is within the sole proprietorships too, because you're an individual, a sole proprietor, they'll do like a deposit verification or a spot check like audit. So those 3 things, they love celebrities because it gets in the news. The high net worth individuals, they can kind of get a big, small bite can have a big impact on those. And especially if you're a sole proprietor, they look at you as an individual. So you may, and actually, yeah, we have a client. This happens too, and because of their entity structure, the individual has the license and they transfer the money to the company because they're a financial planner. So they individually hold it. Their gross revenues are over $1 million. The franchise tax board does a spot check audit. Hey, we want to make sure those deposits are all going to the corporation. So even though the net profit is not $1 million, they'll look at his gross because they're saying, hey, individually, you made over $1 million. We want to make sure this is correct. So we see that.
Yeah, so to answer your question, Corey, it's not random. There's actually red flags that the IRS and also the FTB is looking at, or even each state. When you do those mistakes, and we actually look at that when we do prepare a tax return to make sure that all of us are in order. When you do make mistakes, that's when the IRS said, ooh, there's something weird on this tax return. You need to go ahead and audit it. Bill?
Yeah, as Dianne was just saying, random selection of an audit is very rare, just like maybe 1%. But whether it's an audit or an IRS letter or a state letter, you just don't want to draw any attention to your tax return. So one of the key things you want to do is you want to file your taxes electronically. And then you always want to make sure that whatever you're reporting is matching whatever the IRS already knows, so that your 1099 matches exactly what the IRS says. Even if you're reporting that income in your business, you still want it to be reported on your personal tax return. Then you show it as a nominee income that flows through to your entity, but you always want to make sure that you match whatever the tax return, what the tax documents that the IRS already has. And you can try to avoid amending tax returns. Amending a tax return is going to get looked at by the IRS. Sometimes you have to, you can't avoid it. Your tax return was done incorrectly, by a prior person. So when you get that tax return, you need to amend it. But doing so, you really want to make sure that you have a good CPA doing it, because the narrative, the explanation of changes on that tax return is crucial to getting that amended tax return processed without them sending you a letter and without doing an audit on you. So that's what I would look at, is really just making sure you have a good documentation, good record keeping, that you match all the tax documents that the IRS already has.
Awesome. And Dianne mentioned in the middle of this too, you talked about just the right classification of contractor versus employee. can be a major red flag when there's a lot of independent or 1099 or under the table income. Okay, when is it too late to elect to be treated as an S-Corp with the IRS if we originally elected to be an LLC? Does that question make sense?
Yes, you can file for an entity reclassification. So you could do that in the current year. And what you're doing is you're still an LLC, but you're going to be taxed as an S corporation. So you just file the form during the year. So you want to be, having that election effective for 1/1. And then you filed it during the year, and for the 2021 year, you could be a S corp.
Cool. So if we filed an extension and we're filing 2020 taxes, we would still have to be an LLC elect this year because we didn't get the election in the previous year, correct?
It wouldn't have been done a timely manner.
Cool. Let's see. Are there any downsides to filing tax extensions?
Well, not necessarily. I mean, the one thing would be if you're going to owe taxes potentially, if you don't really know what your balance due is, you don't have your taxes completed by April 15th, you don't make that payment, you're going to get a penalty on that payment. So, I mean, looking at that, when we're doing taxes, we already know pretty much what the taxpayer is going to owe because we do planning prior to the year end. So we know what that's going to be. So putting someone on extension is not anything crucial. There are some people that even think that the IRS has a quota of audits that they have, and they select all the audits by the tax returns they get by April 15th. So some people want to go on extension because they think it minimizes their risk of audit. I don't know if that's true or not, but I just think filing the tax returns accurately and timely is going to minimize your risk of an audit.
Okay, let's see. We've got a couple more. First of all, Allan, you asked at one point in this, could I build a house? The answer is no, I could not build a house, okay? I want to be clear about that. So let's see. Where do you typically find the most waste when it comes to business finances that we should look at in our own business?
I'll chime in. Where I see is the deductions that aren't hitting the books. That ends up being a common one.
Yeah.
The adjusting and closing entries, the business use of the home, and then typical things of what especially as an executive, they're legally allowed to deduct some of those deductions, but they're picking it personally because they just don't know. So oftentimes we see the internet, we see the home. There's sometimes it makes sense to have the vehicle pick that up, have the corporation rent the business use to the home. Ends up being a common deduction area that's really like almost a quick immediate one. And then depending how we see the deductions and how their business has been operating, especially if it's been profitable in the last 3 years, they've improved those operations. We see sometimes they can be eligible for the R&D tax credits. If they have rentals, especially if they're acquiring new properties and they've been acquired in the last 2 to 4 years, accelerated depreciation, getting that cost segregation study. So it's the things that that doesn't touch the bank account. And that's where we see one of the quick, usually immediate, and that they've overpaid their taxes, especially if their business is qualified for QBI. Bill?
No, I think that's exactly right. I think the 2 areas that it comes in is they don't know what's the possible tax deduction, and the accounting records are not adequate to tell them what they do have as far as a tax deduction.
Perfect. Okay, I have one that wasn't actually asked, but it's kind of a leading question. I know that there's some people on this call who are not business owners or entrepreneurs. They are members of maybe a leadership team, or they have well-paying jobs, but they are ultimately not their own business. Should they still consider or work with a CPA to set up an entity that they can then start to write some things off in their own kind of personal, so they're still getting paid from another business, but having some sort of either an S-Corp or an LLC on their own on the side that they can really start to take advantage of tax-wise? Is there any benefit to that, or is there a certain threshold or something that needs to be met in order to do that? Does the question make sense?
Yeah, you wanted to answer it, Allan, with me?
You can go, Bill.
Okay, thanks. The thing is that to set up an entity is always a good idea, I think, to generate some deductions and so on. The issue is going to be there needs to be some income flowing into that entity. So how are they going to get income in there? If they're doing some kind of nominal side job to get income in there, then I would say yes. If they just have a W-2 and they're going to throw some money in their personal net wages in there to pay some of those expenses, I mean, are you really saving money by doing that? You know, I don't know if that's the best thing to do, but if there's a possibility of generating some side business, I would say yes, do that, because we can definitely write things off through the entity and have that loss flow through to the personal tax return. And you don't necessarily have to worry about that showing a profit 2 or 5 years, as long as there's a profit motive in the business, then you should be held okay.
And especially now what we're seeing too with like key employees that are highly compensated, where they're making over $250,000 a year, they've been with the company for a while. We can help create those executive comp plans that have now been brought to the business owner and to the team, and you're eligible to discriminate where the business gives the deduction, and the benefit for that employee can be either a deferred in the compensation, or they can tailor the plan with some other tools with an executive comp plan where that benefit, they don't have to give it to everybody, but it can be something for employee retention, especially right now, or kind of creating that golden handcuff kind of situation, which we help a lot of our clients do, which is something that we have been looking at, especially the businesses between 25 and 50 million, because those employees are looking to either retire, but they don't want to have that big tax, impact.
Awesome. I don't think there's any other questions. I do have just a couple things before we go. I always talk about when I'm working with my leadership teams about we can spend our time working in addition, or we can spend our time working in multiplication. And so often we get stuck in working in addition, where it's just the task and how much we can accomplish in a day. When we take time and set aside and we work on the business and we get smarter about the way that we're approaching our business, we can start to have time that multiplies and turns into significantly more money. I hope this hour was one of those where everybody took a little bit of time off. They're not actually selling homes or managing their team or anything like that, right? But at the end of the day, if we can start to approach our business in a different way, have a much greater approach and strategy towards our finances, I think it can really start to work in multiplication. This 1 hour can save tens or hundreds of thousands of dollars by strategizing the right way. And so I want to thank you guys for that. The second thing I want to say is, if you guys, for anybody who's on the webinar now, or even if you're watching this later, I know there's a bunch of people who wanted to watch the recording. If you found value in this, please send me an email or post it in the chat right now. Let me know what you really appreciated about this. I'm going to create this into a blog post. I'd love to have a couple testimonials and things that I can type up there of just kind of what you got out of this, so that other people can know what to expect. You can always email me at corey@corey-wright.com. That's COREY at corey-wright.com. I'll also make sure to pass all those love letters on to you guys, since you guys are the one who did all the work for this. And I just wanted to thank you guys. So couple just kind of final things. If you have any other follow-up questions, or you just wanted to say thank you, you can reach Allan. What's the best email, Allan?
Allan@hetzelcpa.com. That's 2 A's, 2 L's, ALLAN@hetzelcpa.com. And then I can, set you up.
The Calendly link, which is calendly.com/1040tax. You can set up a 15-minute call. Again, I just want to thank you guys. We are right up against our hour. We'll keep it tight. If there's anything that you guys want to close with, feel free to do so.
Beautiful. Be proactive. Schedule the time with those professionals now. As those tax laws change, those advisors will be booked, and it might be too late.
Awesome. Thank you all. Thank you all for attending. And Allan, Dianne, and Bill, thank you guys so much.
Thank you, guys.
It's been a pleasure.
So anybody who wants any of those documents, by the way, there's the monthly checklist and a couple things that you guys have presented. I'll have all those in the show notes, or where you can get those. And then that will be emailed out to everybody tomorrow, as long as I can get this posted and live and edited and all that stuff by tomorrow. So you guys can look out for that. You'll have all access to that stuff, or you can email Allan directly. All right. Thanks, guys.
Beautiful.
All right. Thank you.
Thank you, guys.